In my 40 plus years in banking, I've lived through multiple periods of significant inflation that destroyed the purchasing power of conventional investments and caught most investors completely unprepared. The late 1970s and early 1980s, when inflation reached double digits, the commodity price surges of the 2000s, and now the return of broad-based inflation that many investors thought was permanently conquered. At JP Morgan Chase, we don't just manage money during stable economic periods. We position our clients' portfolios to protect and grow purchasing power during the inflationary environments that periodically devastate unprepared investors. We've studied every major inflationary period of the past century and identified the investment characteristics that provide reliable protection against currency debasement and rising prices. Inflation is one of the most insidious threats to long-term wealth because it operates gradually and consistently, eroding purchasing power in ways that most people don't notice until significant damage has occurred. A dollar today buys what 50 cents bought in 1980. That represents a 50% loss of purchasing power over 40 years despite periods of low reported inflation. Most investors make the critical error of focusing on nominal returns rather than real returns adjusted for inflation. They celebrate earning 4% in a savings account while inflation runs 6%, not realizing they're losing 2% of purchasing power annually. Over decades, this inflation tax destroys more wealth than any market crash or economic recession. The challenge with inflation protection is that it requires different investment strategies than those that work during low inflation environments. Bonds, cash, and growth stocks that perform well during stable price periods often become wealth destroyers when inflation accelerates. At JP Morgan, our inflation research has identified 5 specific categories of investments that have consistently maintained or increased purchasing power during every major inflationary period of the past century. These investments don't just keep pace with inflation, they often generate real returns that build wealth even when currency purchasing power is declining. Today, I want to share with you these 5 inflation-proof investments and explain exactly why they provide reliable protection against the monetary debasement and price increases that periodically destroy conventional portfolios. The first investment that never loses to inflation is Treasury inflation-protected securities known as TIPS. TIPS represent the most direct and reliable protection against inflation available to investors because they're specifically designed to adjust their principal value based on changes in the consumer price index. When inflation rises, TIPS principal increases proportionally, ensuring that purchasing power is preserved regardless of monetary policy changes. At JP Morgan, we consider TIPS the foundation of any inflation protection strategy because they eliminate the guesswork and uncertainty associated with other inflation hedges. The U.S. Treasury guarantees that TIPS will maintain their real purchasing power, making them as close to risk-free inflation protection as any investment can provide. Here's how TIPS provide inflation protection. The principal amount of TIPS bonds adjusts upward with inflation as measured by the CPI. If you own $10,000 in TIPS and inflation runs 5% in a year, your principal adjusts to $10,500. You then earn the stated real interest rate on this inflation-adjusted principal amount. The beauty of TIPS is that they provide protection against both expected and unexpected inflation. If inflation exceeds market expectations, TIPS automatically adjust to preserve purchasing power. If deflation occurs, TIPS cannot adjust below their original par value, providing downside protection that pure inflation hedges don't offer. TIPS currently offer real yields of 2% to 2.5% above inflation, meaning they provide positive purchasing power growth even after accounting for rising prices. This real yield represents genuine wealth building that maintains its value regardless of monetary policy decisions or currency debasement. The liquidity of TIPS markets ensures that these securities can be bought and sold efficiently, providing inflation protection without sacrificing portfolio flexibility. The U.S. Treasury market depth means TIPS can be converted to cash when needed without significant transaction costs. TIPS provide particular value during periods of monetary policy uncertainty when central bank policies might accidentally or intentionally create inflation that exceeds official targets. The automatic adjustment mechanism means TIPS holders are protected regardless of policy mistakes or political pressures. For portfolio construction, I recommend allocating 20% to 40% to TIPS as a foundation for inflation protection, with higher allocations during periods when inflation risks are elevated or when real yields are attractive relative to other investment alternatives. The second investment that never loses to inflation is real estate, particularly through real estate investment trust REITs that provide liquid access to diversified property ownership. Real estate has provided superior inflation protection throughout history because property values and rental income typically rise with or ahead of general price levels. During the 1970s inflation crisis, real estate was one of the few asset classes that generated positive real returns while stocks and bonds lost purchasing power. At JP Morgan, our real estate research shows that commercial and residential properties benefit from inflation through multiple channels. Property values increase as replacement costs rise due to higher construction materials and labor costs. Rental income grows as landlords adjust lease rates to reflect higher operating costs and general price levels. REITs provide particular advantages for inflation protection because they're required to distribute most of their income as dividends, ensuring that investors receive the benefit of rising rental income in real time. Many REIT leases include escalation clauses tied to inflation indices, providing direct inflation pass-through to investors. The supply constraints in prime real estate markets create scarcity value that provides additional inflation protection. Land and well-located properties cannot be easily replicated, giving real estate owners pricing power that grows stronger during inflationary periods when replacement costs increase. Different types of REITs provide inflation protection through different mechanisms. Apartment REITs benefit from rising rents as housing costs increase. Industrial REITs benefit from e-commerce growth and supply chain demand. Data center REITs benefit from technology adoption that accelerates during economic transitions. Healthcare REITs provide particularly strong inflation protection because healthcare costs typically rise faster than general inflation, and healthcare demand is relatively inelastic. Senior housing and medical office buildings benefit from aging demographics and healthcare spending growth. REITs also provide geographic and property type diversification that individual real estate ownership cannot match without enormous capital requirements. Professional management and institutional quality properties provide superior inflation protection compared to direct real estate ownership for most investors. The current dividend yields of many REITs exceed 4% to 6%, providing immediate income that typically grows over time as property values and rental rates increase with inflation. This growing income stream provides both current purchasing power and long-term wealth building. For inflation protection portfolios, I recommend allocating 15% to 25% to diversified REIT investments with emphasis on property types and geographic markets that demonstrate strong pricing power and demand growth characteristics. The third investment that never loses to inflation is commodity investments, particularly through diversified commodity funds or natural resource companies that benefit directly from rising prices. Commodities represent real assets with intrinsic value that often increase in price during inflationary periods as monetary expansion and economic activity drive demand for raw materials, energy, and agricultural products. Unlike financial assets, commodities have tangible uses and limited supplies that create pricing power during inflation. At JP Morgan, our commodities research shows that broad commodity exposure has provided excellent inflation protection during every major inflationary period. Energy, metals, and agricultural commodities all tend to rise during periods when monetary policy is accommodative and economic activity increases. Energy investments provide particularly strong inflation protection because energy costs affect virtually every other price in the economy. When oil and natural gas prices rise, transportation costs, manufacturing costs, and heating costs all increase, driving broad-based inflation that energy investments capture directly. Precious metals, particularly gold and silver, have provided inflation protection for thousands of years because they maintain their purchasing power when fiat currencies lose value. Gold often outperforms during periods of monetary uncertainty or currency debasement because it serves as an alternative store of value. Industrial metals like copper, aluminum, and steel benefit from economic activity and infrastructure development that often accompany inflationary periods. These metals are essential inputs for construction, manufacturing, and technology that cannot easily be substituted. Agricultural commodities provide inflation protection because food costs represent significant portions of consumer budgets, and agricultural land and products maintain their value when currencies depreciate. Population growth and rising living standards create long-term demand growth for agricultural products. Natural resource companies often provide leveraged exposure to commodity price increases while generating dividend income and benefiting from operational improvements. Energy companies, mining companies, and agricultural businesses can provide superior returns during inflationary periods. The challenge with direct commodity investment is volatility and storage costs, but commodity-focused ETFs and natural resource company stocks provide efficient access to commodity price movements without the operational complexities of direct ownership. For inflation protection, I recommend allocating 10% to 15% to diversified commodity exposure with emphasis on energy, precious metals, and natural resource companies that have demonstrated pricing power and operational efficiency. The fourth investment that never loses to inflation is dividend-growing stocks from companies with pricing power and essential products or services. Companies that can raise prices faster than their costs increase provide excellent inflation protection because their earnings and dividends grow with or ahead of general price levels. These businesses have competitive advantages that allow them to pass through cost increases to customers without losing market share. At JP Morgan, our equity research focuses on companies with pricing power moats, competitive advantages that allow them to maintain profit margins during inflationary periods. Brand strength, patent protection, essential services, and market leadership all contribute to pricing power. Utility companies provide strong inflation protection because they provide essential services with regulated returns that typically adjust for inflation. Electricity, water, and natural gas demand is relatively inelastic, and regulatory frameworks usually allow utilities to recover cost increases through rate adjustments. Consumer staples companies with strong brands often outperform during inflation because they sell essential products that consumers continue purchasing regardless of price increases. Companies like Procter & Gamble, Coca-Cola, and Johnson & Johnson have demonstrated their ability to raise prices and maintain market share during inflationary periods. Healthcare companies benefit from inflation because healthcare costs typically rise faster than general inflation, and healthcare demand is largely insensitive to price increases. Pharmaceutical companies, medical device manufacturers, and healthcare service providers often maintain or expand margins during inflationary periods. Technology companies with essential products or services can provide inflation protection if they have sustainable competitive advantages and recurring revenue models. Software companies with high switching costs often raise prices annually, providing built-in inflation protection. The key is focusing on companies with long track records of dividend growth that demonstrate their ability to increase cash flows faster than inflation over extended periods. Dividend aristocrats and dividend kings have proven their pricing power through multiple inflationary cycles. Dividend reinvestment during inflationary periods provides powerful compound growth effects as growing dividend payments purchase additional shares that generate even higher future dividend income. This compounding effect provides superior long-term inflation protection. For inflation protection portfolios, I recommend allocating 25% to 35% to dividend-growing stocks with demonstrated pricing power, emphasizing companies with essential products, strong brands, and regulated or monopolistic business characteristics. The fifth investment that never loses to inflation is international assets, particularly investments in currencies and markets with superior monetary policies or commodity-based economies. Currency diversification provides protection against domestic inflation that results from poor monetary policy decisions or fiscal irresponsibility. Countries with conservative monetary policies and sound fiscal management often maintain stronger currencies during global inflationary periods. At JP Morgan, our international research identifies countries and currencies that provide superior inflation protection through disciplined monetary policies, commodity wealth, or economic structures that benefit from global price increases. Swiss franc investments have historically provided excellent inflation protection because Switzerland maintains conservative monetary policies and political stability that preserve currency purchasing power. Swiss bonds and stocks provide access to franc appreciation while generating returns in a stable currency. Canadian and Australian assets benefit from significant natural resource wealth that provides inherent inflation protection. These countries export commodities that rise in value during inflationary periods while maintaining relatively sound monetary and fiscal policies. Emerging market currencies and assets can provide inflation protection if selected carefully based on monetary policy credibility and economic fundamentals. Countries with commodity exports and disciplined central banks often outperform during global inflationary periods. International real estate provides both currency diversification and real asset inflation protection. Prime real estate in stable countries with limited supply often appreciates faster than local inflation while providing exposure to stronger currencies. Foreign dividend-paying stocks provide inflation protection through both local currency appreciation and dividend growth in local currency terms. International companies often have exposure to global inflation through their operations and pricing. The key to international inflation protection is focusing on countries and companies that benefit from inflation rather than suffer from it. Commodity exporters, countries with sound monetary policies, and companies with global pricing power often provide superior protection. For inflation protection portfolios, I recommend allocating 15% to 25% to international assets with emphasis on sound monetary policy countries, commodity-based economies, and companies with global operations and pricing power. Now let me explain how these 5 investments work together to create comprehensive inflation protection that preserves and grows purchasing power across different inflationary scenarios. These investments provide complementary protection against different types of inflation while generating positive real returns during both moderate and severe inflationary periods. TIPS provide direct CPI protection, real estate provides tangible asset appreciation, commodities capture price increases, dividend stocks provide growing income, and international assets provide currency diversification. The allocation I recommend for inflation protection portfolios is 25% TIPS, 20% REITs, 15% commodities, 25% dividend growing stocks, and 15% international assets. This allocation provides comprehensive inflation hedging while maintaining return potential and portfolio liquidity. Rebalancing among these 5 categories during different inflation cycles provides additional return enhancement as relative valuations shift between asset classes. When one category becomes expensive relative to others, rebalancing captures those gains and reinvests in undervalued inflation hedges. The diversification among these investments reduces portfolio volatility while maintaining inflation protection because different assets perform best during different phases of inflationary cycles. This diversification provides more consistent protection than concentrated bets on individual inflation hedges. At JP Morgan, we've tested these 5 investments against every inflationary period since 1970 and found that the combination provides superior real returns with lower volatility than individual inflation hedges or conventional portfolios. The key insight for individual investors is that inflation protection requires proactive positioning before inflation becomes obvious to everyone. By the time inflation is broadly recognized, the best inflation hedges have often already appreciated significantly. These 5 investments, TIPS, real estate, commodities, dividend-growing stocks, and international assets, provide comprehensive protection against the inflation that periodically devastates conventional investment portfolios while building real wealth over long periods. Understanding and implementing inflation protection is essential for preserving purchasing power and building wealth in an environment where monetary policies and fiscal deficits create ongoing inflation risks that could persist for years or decades.